This podcast is sponsored by BuyBiz.io. Discover premium AI-driven online businesses for sale, perfect for standalone growth or seamless integration. Explore now at BuyBiz.io to kickstart your digital success.
How to structure financing for a business acquisition successfully. Learn the essentials of structuring financing for buying a business, from cash and loans to seller financing. Find great AI-based business listings too. Structuring financing for a business acquisition, how to make it work. One of the trickiest parts of buying a business isn't just deciding which one to buy, but figuring out how to pay for it. Structuring the financing for a business acquisition can feel like trying to solve a puzzle without all the pieces, but when you get it right, it can be a total game changer. So, let's just chat about what goes into it and how you can approach it without losing your mind. First off, when you're thinking about financing an acquisition, you've got to remember, there's no one-size-fits-all. Every deal looks different depending on the business, your financial situation, and the opportunities for growth. Still, there are some common ways people structure the money part. 1. Knowing your financing options. Here's the rundown on the main options you'll probably consider. Cash financing. If you've got the cash on hand, this is straightforward and avoids debt. But let's be honest, most people don't have that kind of money just sitting around. Debt financing. Borrowing money through loans, either from a bank or through private lenders. This means monthly payments and interest, but doesn't dilute ownership. Seller financing. This is like the seller acting as a bank, allowing you to pay over time. It's often helpful because the seller is vested in the business's success and might offer better terms. Equity financing. Bringing in investors who get a piece of the business in exchange for their money. This means you share control but reduce your personal financial risk. 2. Mix and match. It's rarely just one. Usually, buyers don't just choose one method. Most deals are a mix. For example, you could put down some cash, get a bank loan, and have the seller finance the rest. This layered approach helps reduce risk and keep monthly obligations manageable. Let's say you're eyeing a tech company that costs $500,000. Maybe you put $100,000 in cash, get a $250,000 bank loan, and have the seller finance $150,000 with repayments over 5 years. Structuring it this way balances your upfront cost with manageable payments. 3. Get comfortable with your cash flow. One of the key things lenders or sellers will want to see before agreeing to finance you is your cash flow. After all, how else can you prove you'll make the payments? Before finalizing financing, take a hard look at the target business's financials, especially cash flow and profits. If the business isn't generating enough to cover debt payments comfortably, you've either got to negotiate better terms or reconsider the deal. Remember, banks like to see at least 1.25 to 1.5 times coverage on debt payments from operating cash flow. Seller financing will want similar reassurance. 4. Use earnouts to bridge gaps. Sometimes, buyers and sellers can't agree on the price because the future is a bit uncertain. That's where an earnout comes in. A portion of the price is paid out based on future performance milestones. While earnouts can bridge valuation gaps, they also mean you have to keep the business operating well for a set period, and sometimes they can lead to tense relationships if things don't go as planned. Still, they're a flexible tool that can help you structure financing with less upfront risk. 5. Keep your eyes on the legal stuff. Every deal needs a thorough legal review. How the financing is structured impacts liability, taxes, and control of the business. Working with a good lawyer and accountant isn't optional, it's essential. And while you're at it, make sure your financing mix matches your long-term goals. If you want to grow quickly, taking on too much debt might hold you back. If you want to keep control tight, equity financing might not be your friend. 6. Where to find businesses and financing opportunities. Speaking of finding businesses, have you heard about Archie Boy Holdings' AI-based businesses for sale? They specialize in AI-powered companies, which are incredibly exciting and have great growth potential. If you're interested in modern tech-driven businesses, checking out their listings could be really worthwhile. They've got a platform where you can explore hundreds of businesses for sale, including some amazing AI-based enterprises that might just fit your acquisition plans perfectly. Explore our listings today. It's a great place to find businesses that come with well-structured financials and even seller financing options sometimes. Financing a business acquisition isn't always simple, but breaking it down into these pieces makes the journey much easier to handle. Look for the right mix of funding, understand your cash flow, get professional advice, and keep an eye out for great opportunities like those at Archieboy Holdings. Thanks for tagging along with me on this. Hopefully, if you ever find yourself ready to buy a business, you'll have a better idea of how to justify and structure the financing to get you across the finish line.